Let's work through the chapter 23 and 24 review. So our first question here says that Thompson Industries incurs unit costs of $8, $5 for variable, and $3 for fixed whenever they make an assembly part for its finished product. And then a supplier comes in and offers to make 10,000 of that assembly part for $6 per unit. If the offer is accepted, Thompson Industries will save all the variable costs, but none of the fixed costs. What we need to do is prepare an analysis showing the total cost saving, if there's any, that Thompson Industries would realize by buying the part. And then based off that analysis, we can make the decision whether they should buy the part or continue manufacturing it. So we're going to set up a table like this, right? And we want to talk about total cost savings. So we're going to just look at the different cost pieces that we have here in this situation, right? We have variable manufacturing costs, fixed manufacturing costs, and our purchase price. So let's focus just on the make column right now. So if we make this assembly part, what kind of costs are we looking at? Well, we have variable and fixed, right? We're told that it's $5 for variable, $3 for fixed per unit. And we're talking about this offer of 10,000 units. So we multiply those by 10,000 and we find our variable and fixed costs under the make column. Now, if we were to make this part, we're not buying it. So that means that we don't have a purchase price, right? So our total annual cost will just be this 80,000. Now, if we go over to the buy column, it tells us that if we accept this offer from a supplier and end up buying this product, we would save all of our variable costs, but none of our fixed costs. So we'll put a 0 here for variable, but we still have all 30,000 of our fixed. Now our purchase price, if we buy the product, we do have a purchase price, right? So we're buying 10,000 units for $6 a piece. We multiply those together, and we see that we would have to pay a total of 60,000 for the purchase price under this buy situation. So our total cost there, we're looking at 90,000, right? We just add up the 30 and the 60. Now we need to think about the effect on the net income. So what we're going to be doing is we're going to be comparing the make versus the buy column, right? So just with variable, if we were to make these products, we would have $50,000 in variable costs. If we were to buy them, that would go down to 0. So a decrease in cost is going to have an increasing effect on our net income. So we show that as a positive 50,000. Now fixed. Fixed remains the same, so there's no effect, right? Purchase price, we went from having to pay 0 under the make scenario to paying 60,000 if we were to buy them. So our costs were increasing, and if your cost increases, your net income would decrease. So we show that as a negative 60,000. Now, a few different ways that we can find this last piece. We could go across, right? We could say 80,000 up to 90,000, or we could go down, where we take 50,000 minus 60,000. Either way, we're going to end up with this negative 10,000, meaning that our net income would be $10,000 less if we were to buy than if we were to make this product. Because our cost under the buy situation, buy scenario, that was 90,000. If we were to make it, it would just be 80,000, right? So we want to have the lower cost amount. So that brings us to part B of this problem, right? Where we have to make the decision now whether we should make the product or buy the product. Well, we just talked about it. If we make the product, our cost is $80,000. If we buy the product, our cost is $90,000. We want to have the lowest amount of cost as possible. So we're going to choose make. Now, question number 2. This is a bit of a long question here. So what we're dealing with here are budgets. Right? So we're told that Coulter Company had sales in 2018 of $6.8 million and a gross profit of $1.1 million. Management is considering 2 alternative budget plans to increase its gross profit in 2019. Right? So they took a look at 2018's numbers and they said, okay, we want to make our gross profit even bigger the following year. So what are the 2 different plans that we could consider here, right? So plan A would increase the selling price per unit from $8 up to $8.40. And when doing so, that would decrease the sales volume, so the amount of units being sold, by 10% from its 2018 level. So yes, we are selling each unit for more, but we're going to be selling fewer units. So we'll see what kind of effect that has on our gross profit. Plan B would decrease the selling price per unit down to $7.50. And when doing so, the marketing department expects that that will increase the sales volume by 100,000 units. So we have a couple different approaches here. Right? One, we could increase the selling price, which could decrease the sales volume. While plan B is decreasing the selling price per unit. But when we do that, more people are going to be interested in buying it. So we'll see an increase in our sales volume by 100,000. Now, at the end of 2018, we're told that Coulter Company has 40,000 units of inventory on hand. If plan A is accepted, the 2019 ending inventory should be equal to 5% of our 2019 sales. If plan B is accepted, the ending inventory should be equal to 60,000 units. Each unit produced will cost $1.80 in direct labor, $1.40 in direct materials, and $1.20 in variable overhead. The fixed overhead for 2019 will be using the amount of $1,895,000. So that's a lot of information here, right? What do we have to do? We have to first prepare a sales budget for 2019 under each plan, then prepare a production budget for 2019 under each plan, compute the production cost per unit under each plan, and then we need to figure out which plan should we go with, right? We're making all of these budgets, figuring out our cost per unit, so then that way we have the information to make a decision. So let's start with the sales budget, right? So the sales budget, if we just look at the framework of it before we even talk numbers, you'll notice it's expected unit sales, unit selling price, and total sales. Expected unit sales is how many units of the product do you think you're going to sell. Unit selling price is the price per unit there. We multiply those two and we see how much in total sales we're actually going to be making. So plan A gave us an $8.40 unit selling price. Plan B gave us $7.50. Now, how do we figure out the expected unit sales, however, right? So we're told that under plan A, sales volume will decrease by 10%. But we need to first figure out what we were even at for the previous year, right? So we need to find 2018's sales volume. To do that, we're going to take our total sales from 2018 and divide that by the selling price per unit for 2018. So we were told initially that we had $6.8 million in sales in 2018. And then in the problem, we were also told that our 2018 unit selling price was $8. Because if you recall, we were told that Plan A would increase the unit selling price from $8 up to $8.40. Right? So they snuck that in there as the 2018 unit selling price for us. So when we divide those, we can see that our sales volume from 2018 was 850,000 units. So now we can figure out, okay, if we want to decrease that by 10%, we can multiply 850,000 times 90% or times 0.9. And we see that in 2019, we're going to sell 765,000 units. So we can toss that in there for the expected unit sales. We multiply our expected unit sales by our unit selling price, and we get our total sales there of $6,426,000. So you'll notice that's actually less than what our sales were in 2018. Right, our sales in 2018 were 6.8 million. So we'll just keep that in mind as we're going through here. We still definitely don't have enough information to make that decision quite yet. Plan B, we have our unit selling price already. We need to find the expected unit sales, right? We already know 2018's sales volume was 850,000. By decreasing our unit selling price, we think that that could increase our sales volume. So, 2019 sales volume, we're expecting it to be 950,000. So we plug that in, and we multiply out, and we can see that our total sales under this Plan B would be over $7 million. So just taking a look here at our sales budget, we might be leaning more towards Plan B because our total sales are higher, right? We want the highest possible sales. However, there's more to consider here, right? This is just one little piece of the puzzle. So we have our sales budget figured out. Next up, we're going to work on our production budget. So again, let's not talk about the numbers quite yet, and let's just talk about what goes on a production budget. So we start off with our expected unit sales, which we already found those back when we did our sales budget, right? So we have the numbers already in there. Then we want to add in any amount for the desired ending finished goods in units, right? So at the end of 2019, what do we want to have left over in our inventory? You add that amount to the expected unit sales. That's going to tell you how many total required units you have. Then we subtract out what we began with, right? The beginning finished goods in units. So what did we go into 2019 with? When we subtract that amount from the total required units, that tells us our required production units. How many units do you actually have to produce in 2019 under each of our plans? So that's what we're trying to figure out here with this production budget. We already know that we started the year with 40,000 units. And now that was a set amount, right? That's not going to change based off of our two different plans. That was, okay, at the end of 2018, we had 40,000 units in our inventory. That is set, that is decided. Desired ending finished goods, that's where things change up, right? And the expected unit sales, we already see those have different numbers as well. So let's just look at the desired ending finished goods for Plan A right now. We were told that under Plan A, we want our desired ending finished goods to be 5% of sales. So we take our expected unit sales, multiply it by 5%, and we get this 38,250. We add that to our expected unit sales, we get 803,250. Subtract out our beginning finished goods, and we can see that under Plan A, we will have to produce 763,250 units this year. So that's going to be something that we'll keep in mind here as we look at Plan B now. So we already have our expected unit sales. We already have our beginning finished goods, right? Now we need to figure out the desired ending finished goods for Plan B. We were told outright that should equal 60,000 units. Perfect, right? Easy math there. We just plug in the 60,000. Total required units, we add up our expected unit sales and the desired ending finished goods, and we're just over 1 million required units. Subtract out our beginning finished goods, and we see that our required production units are 970,000. So now, when we compare the two plans right now, we see that under Plan A, we only have to make 763,000 units. Plan B, we have to produce almost 200,000 more units. That number's up at 970 now. Right? So if we think back to the sales budget that we did, Plan B was going to have a higher sales amount. But Plan B is also going to have more production costs because we have more units that we need to produce. So now we need to figure out our cost per unit. So the way that we need to figure out cost per unit is by taking the variable costs plus the fixed cost to get our total cost amount. And then we divide that by our total units, and that gets us our unit cost. Now, our fixed costs, those were given to us. Our total units, we just found that in our production budget. Our variable costs, that's going to be something that we need to calculate. So we have different variable costs, right? We have direct labor, direct materials, and variable overhead. We were given all of those amounts. We can see that our total variable cost will be $4.40 per unit. And now we can use that amount to figure out the variable cost for both Plan A and Plan B. So looking at just Plan A right now, $4.40 times our total number of units, the 763,250, and we can see that our total variable costs will be $3,358,300. So let's plug that in as our total variable for Plan A. We add that to our total fixed for Plan A, and we're at $5,253,300. Now we take that total cost, divide it by our total units, and we can find that our unit cost is going to be $6.88 per unit. Now, we move to Plan B. Variable cost per unit, still the same. Still $4.40 per unit. We multiply that by our total number of units. We see now that our variable costs under Plan B are just about 4.2 million. We plug that in. We add that to our total fixed cost to get our total cost of just over 6 million. To find our unit cost, we take that total cost, divide it by our total units, and we see that our unit cost is $6.35 per unit. So let's compare these two. So because we have more units that we need to produce, Plan B has the higher total cost and the higher total variable cost. However, Plan B has the lower unit cost. So we'll keep that in mind as we move ahead to make our decision, right? Which plan should be accepted? Well, everything was about gross profit. This company wanted a higher gross profit. So we should find the gross profit for each plan, right? We take our sales, subtract our cost of goods sold, and that will give us our gross profit. Our sales amounts, we take that from the sales budget, right? Plan B had a higher sales amount. Cost of goods sold, what we're going to do here is we're going to take our units sold times our unit cost that we just found. So for plan A, that's 765,000 times $6.88. Plan B, that's 950,000 units times our $6.35. So we can find our cost of goods sold there. So plan A, just about 5 million. Plan B, just about 6 million. Now our gross profit is when we take our sales minus our cost of goods sold. So we do that, and we see Plan A's gross profit is $1,162,800, and Plan B's gross profit is $1,092,500. So if we think back to all of the different steps along the process here, at first we were leaning towards Plan B because that had the higher amount in sales. And then we saw that Plan B was going to make us need to produce more units. So that was kind of worrisome, right? Because that means that we would have more manufacturing costs. But then we saw that Plan B had a lower unit cost, right? So we've been all on this roller coaster throughout this problem here. But it all comes down to gross profit. So which plan should be accepted? We're going to accept Plan A because that one has the higher gross profit. Right? So even though we are selling fewer units and it has a higher unit cost, that one still comes out to have the better gross profit of the two. So that's the plan that we're going to accept. Now, our next question here says that Page Corporation has 2,000 pounds of raw materials in its December 31st, 2018 ending inventory. Required production for January and February of 2019 are 4,000 and 5,000 units respectively. 2 pounds of raw materials are needed for each unit, and the estimated cost per pound is $6. Management desires an ending inventory equal of 25% of next month's materials requirements. Prepare a direct materials budget for January. So we're still dealing with budgets, this time a direct materials budget. So this is what a direct materials budget is going to look like. Again, we'll talk about the numbers in a bit, but let's just focus on all of the different pieces that we need. So the first step is units to be produced. How many units are we making here? Next, direct materials per unit. How many pounds of materials is needed to make one single unit? We multiply those two, and we can find our total pounds required for production. And then we want to add in our desired ending inventory. So at the end, how many pounds of materials do we want in our ending inventory? That will give us our total materials required. We subtract out our beginning materials inventory. So how many pounds did we have at the start? And that will give us our direct materials purchases. So how much in purchases do we need to make during this month for materials? We then multiply that by the cost per pound to figure out the total cost of direct materials purchases. So let's start filling this out for Page Corporation. So we need to produce 4,000 units this month. There's going to be 2 pounds of materials per unit, which means that our total pounds required for production is 8,000. Then we want to add in the number of pounds that we want in our ending inventory. So we're told that management desires an ending inventory equal to 25% of next month's materials requirements. Next month, we're requiring 5,000 units, 2 pounds per unit, which is 10,000 pounds, right? We want 25% of that in our ending inventory going into next month. So that's going to be our 2,500 that we'll put here for our desired ending inventory. Now we add that to our total pounds required for production, and we see that our total materials required is 10,500. So that's how many pounds we will need this month. Then we want to subtract out our beginning materials inventory. Well, we need to look back to how we figured out our desired ending, right? Management wants an ending inventory equal to 25% of next month's materials requirements. So we're dealing with January here, right? So January's beginning inventory is going to be December's ending inventory, because all that happened was on New Year's Eve, clock hit midnight, and we moved from one month to the next, right? So 1 month's ending is the next month's beginning. We need to remember that relationship here as we're figuring this out. So next month's requirements is January's requirements in this case. So 4,000 units, 2 pounds per unit, we get that 8,000. We need 25% of that. And we find that 25% of 8,000 is our 2,000. Now, direct materials purchases. We get that by taking our total materials required and subtracting out our beginning materials inventory. So we're left with 8,500 here. Now, cost per pound, we were told that each pound of materials we think will cost $6. We multiply that with our direct materials purchases, and we see that we are expecting to have to pay $51,000 for our direct materials purchases this month. Our next question, for Thomas Company, units to be produced are 5,000 in quarter 1 and 7,000 in quarter 2. It takes 1.6 hours to make a finished unit, and the expected hourly wage rate is $15 per hour. We need to prepare a direct labor budget by quarters for the first 6 months ending June 30th, 2019. So we've done a direct materials budget. Now we need to do a direct labor budget. Let's just take a look at the framework, right? We take our units to be produced, and then we have our direct labor time per unit. We multiply those, that will give us our total required direct labor hours. Then our direct labor cost per hour will help us find our total direct labor cost. So we have this set up for quarter 1, quarter 2, and then you see the 6 months. The 6 months column isn't going to come into play until the very end. So we'll talk about what we do then. Let's start with units to be produced, right? Quarter 1 is 5,000, quarter 2 is 7,000. We were told that up in the problem. It's going to take 1.6 hours of direct labor to finish the product. So we multiply those to the units to be produced, and we see in quarter 1, we're expecting our required direct labor hours to be 8,000. In quarter 2, we're thinking it's 11,200. Now, our direct labor cost per hour, it's $15 an hour. We multiply that to the total required direct labor hours to figure out how much we have to pay, right? So 8,000 times 15, 11,200 times 15, and we get $120,000 in quarter one and $168,000 in quarter two. Now for 6 months, we're just going to add up our total direct labor cost. That's the only piece that needs to go into that 6-month column. It's just the total direct labor cost for the first 6 months of 2019. Now, we need to think about flexible budgets, right? So we're told that Myers Company uses flexible budgets to control its selling expenses. Monthly sales are expected to range from $170,000 to $180,000. Variable costs and their percentage relationship to sales are sales commission, just 6%, advertising, which is 4%, traveling is 3%, and delivery is 2%. Fixed selling expenses will consist of $35,000 in sales salaries, $7,000 in depreciation on delivery equipment, and $1,000 on insurance for that delivery equipment. What we need to do here is prepare that monthly flexible budget for each $10,000 increment in sales within the relevant range, right? So what that's saying is prepare it for $170,000 in sales and $180,000 in sales. So let's look at our flexible budget here. We have our sales amounts, right? 170 and 180. Now our variable costs, those percentages are in relationship to sales, right? So sales commission is 6% of our sales amount. So 6% of 170 gets us as 10,200. 6% of 180 gets us 10,800. Now we move down to advertising, that's 4% of our sales. So we take our sales amounts, multiply it by 0.04, and we get 6,800 and 7,200. Now, traveling is 3% of our sales. So we take our 170 and 180 and multiply it by 0.03. We get 5,100 and 5,400. And finally, for delivery costs, it's 2%. So we get 34 and 3,600. Now, our next step is finding our total variable costs, right? So we want to add up our 4 different variable costs that we have. So when you add them up, you get 25,500, and then you get 27,000. So right now, we can see that with the lower sales amount, we have lower costs, right? Because lower sales is going to mean lower variable when all of our variable costs are based off of those sales amounts. Now our fixed costs, we were told these amounts, right? Our sales salaries, we were told they were 35,000. Our depreciation, we were told that was 7,000. Insurance, we were told was 1,000. And so for fixed costs, it doesn't matter how much in sales you make. If you want to make $1 million in sales, you still have these fixed costs. They're not going to change. So our total fixed costs is just adding up our 3 different fixed costs, and we get 43,000. Now our last line here is the total cost, right? So we're going to take the total variable and the total fixed for each activity level. We're going to add them up and find our total cost to be 68,500 and 70,000. Now, the actual selling expenses incurred in December 2019 by Myers Company are as follows. So we just prepared a flexible budget. What we now need to do is prepare a flexible budget performance report for December using the budget data that we just worked on, assuming that December sales were 170,000. So remember, these percentages here for our variable costs, are estimates, they're predictions. They're not always going to be exact. So what we need to do is we need to take that information that we have under the $170,000 activity level and compare it to what actually happened in the month of December. And what actually happened is there in our tables that were given. So we actually had sales commissions of $11,000, actually had advertising expenses of $6,900, right? We're going to compare those to what we expected as our variable costs going in. So our budget information, that all comes from our flexible budget that we just did. Our actual, that's going to come from the information that we were just told, right? So 170,000 in sales. We look at that table that we were just given. Our sales commissions were 11,000. That means that we had an $800 unfavorable difference between the two, right? We budgeted our sales commissions to be $10,200. We actually spent $11,000. So there's an $800 difference, right? And why is it unfavorable? Because our costs were higher than what we expected them to be, right? We talked about this a bit earlier. We want the lowest cost possible. So if your cost is higher than your budgeted amount, it's unfavorable. If it ends up being lower than your budgeted amount, then we would see it as favorable. Advertising is $6,900, so that means we're at $100 unfavorable. Traveling, we got that spot on. It's $5,100, so we don't have any difference there. And delivery was $50 more than what we thought, so $50 unfavorable. We add up our total variable costs, we get $26,450. That's a total of $950 unfavorable, right? A few different ways that we can find that $950. We can subtract our two different total variable costs, right? $25,500, $26,450, and we get this $950. Or we can look at just the difference column that we had. And going into it, we had 800 unfavorable, 100 unfavorable, 50 unfavorable. You can think of favorable and unfavorable as like signs, right? So they're all the same sign. They're all negative, let's say, right? Because they're unfavorable. Since they're all the same, we can add up those three amounts. 800, 100, and 50 all get us 950. And it's all unfavorable. Now, let's look at our fixed costs. We had sales salaries, depreciation, and insurance. Well, they're all fixed. So that means that they don't change, right? So we see zeros as our differences there because our budget and our actual amounts were all the same. Total cost, we take our total variable and add in our total fixed, and we get $69,450, which is $950 more than what our budgeted amount was, so it's $950 unfavorable.